Hello students, welcome to Dr. B.R. Ambedkar Open University, MBA, HHCM, first year, first semester. The subject is Financial Accounting and I am your resource person for today, Dr. Payal Patnaik, and we are going to learn Schedule of Company Final Accounts in today's session. So in today's session, we are going to learn about that what joint stock company is, what are its features, final accounts of the company, overview of Companies Act 2013, general requirements of financial statement and Schedule 3 for that part 1 and part 2. So let's start with understanding or having a brief about what joint stock company is. Joint stock company is a separate person in eyes of law. Means like how you are or I am, similar way in the eyes of law, a company is a separate person. So it is an artificial legal person. That means the company can have its own assets, can borrow money, can sue, can be sued, and can have its own liabilities as well. So as a normal individual deals with its own asset, liabilities and finances, in similar way this company also deals with its own. In similar way the company also deals with its own asset and liabilities. It has separate legal entity because in eyes of law it's a separate person. Capital is divided into shares. Now a company cannot run by itself. It is run by the people who are operating it. Someone has to take a lead and run the operation for the company. Although it's a separate legal person, but it is artificial. It doesn't have a mind of its own or working of its own. Someone has to manage it. So, managing a big company is of not a small amount. It involves huge cost. So that particular cost, if we put in the accounting terms, we call it capital. A lot of capital is required to run a company. Now that huge amount of capital cannot be provided by a single person. So the overall capital of the company is divided into small segments or small parts. Each part is known as a share. So the capital is divided into small shares and people who want to put money in the company, they can buy one share, they can contribute to the capital. It is incorporated under Companies Act. Any company which is being formed, it is incorporated under Companies Act. Earlier it was Companies Act 1956, now it is Companies Act 2013. It has a limited liability. Liability means how much you own from outside, how much you have to pay back. In company, the members are limited to the liability, means that they can borrow the money, but how much they can pay back, how much is the share of them in the company, that much only they have to pay back. So their liability is limited. The shares are transferable, means if one person wants to withdraw his share from the company and doesn't want to participate anymore in the company, they can sell their share to someone who's ready to buy it and they can get the money from that person. For example, Mr. A has some share in a company worth rupees 10,000, but he doesn't want to continue with the company anymore. So he can sell the shares worth rupees 10,000 to Mr. B and then Mr. B will become the shareholder of the company and A can receive the money from B and leave the company. So shares are easily transferable. It can be transferred from one person to another. It has a perpetual succession, means that whether the members go or stay, the company keeps on running. As in the previous point only, we understood that shares are transferable, means the shareholder doesn't stay permanent. They are not always there or they do not stay throughout the life of the company. So the members or the shareholders can be changed, but companies remain as it is for a longer period of time, or we can say till the end. So it has perpetual succession without depending on anyone. And one last point which defines our joint stock company is separation of ownership, and the last point is separation of ownership and management. Means the owners not necessarily manage the company. The owners are the shareholders, but not necessarily that shareholders have to manage the company. They can hire someone who has excellent knowledge in managing the company, and the management can run the company, and they will be getting paid for it. So ownership and management are two separate terms. In some cases the owners can manage the company, but not necessarily they have to do it. They can hire someone who can manage the company on their behalf. So we understood that what joint stock company is. It is an artificial legal person in eyes of law, where the shares are divided among the shareholders who contribute the capital for the company. The company is incorporated under Companies Act, and the management and ownership are separate in companies. Now let's move to the next part, to the final accounts. Now what are final accounts? When we run a company, we have to see through that all the transactions are recorded properly. All the transactions are being classified, recorded and analyzed properly. But how it happens? If we don't have a set of criteria for it, then every company will have their own way of recording the transaction. That is where final accounts come into picture. Final accounts are the financial statements prepared at the end of the year. The year can end on 31st December as well, or on 31st March. It can be a calendar year or a financial year. But at the end of the year, few financial statements are prepared, and it is mandatory to be prepared under Companies Act. Now what are these financial statements which has to be prepared? There are four things which companies prepare when they call it final accounts. The two important ones are balance sheet and profit and loss account. Balance sheet provides the position of the company, or we can say the financial position of the company on a specific date, whereas statement of profit and loss account shows the performance of the company over a period of time. Means during a particular year, how much and where the company has spent the money on. That comes in statement of profit and loss, and balance sheet shows the financial position. Apart from these two important statements, there are two more which are required. One is notes of account. Notes of account shows every additional transaction, or we can say every additional information which is required by the stakeholders has to be pointed out there. For example, what policies company is following, any kind of other information which is vital for the stakeholders to know will come under notes of accounts. And the last statement is board's report or the auditor's report, where they confirm that all the information provided above in balance sheet, P&L, notes of account are true and can be furnished to the stakeholder. So this is the introduction to our final accounts. Let's get deep into this and identify that why standardizing these final accounts are important. Why companies cannot have their own say when they have to maintain the accounts. It happens because of few reasons. The first reason is to ensure the uniformity. If someone here means any stakeholder, it can be the customer, bank, government, creditors, or any other person who has the slightest of interest in company's internal matter, they want uniformity, because they are not only concerned with one company, they are concerned with multiple companies. And if the companies are not uniformly maintaining the accounts, it becomes difficult for the stakeholders to compare and contrast with the statements. So, by following a standardized accounting format, it comes as a uniform for everyone. Next, it protects the investor. Now, when we have a standardized accounting format, it is easier for us to save our investors' interest or money, because they trust what financial statements are provided by the company, and based on that they invest in the company. If they are fooled, or auditor's report is not available, board's report is not available, then there might be some hidden information which is there to fool the investor. But government want to save the investors from these mishaps. That's why they have standardized it, so that all the companies can form the same type of statements, and it can lead to clear understanding for the stakeholders. Then it facilitates comparability. It is easier to compare one company's financial statement to other company's financial statement, because all the items are recorded under same heading and subheading. There is no separate or different format. So, it's easy to compare that which company is doing good and which needs improvement. It is mandate to have the audit. It is mandatory for the audit as well, because auditors who are auditing for companies, they are not auditing for one company, they are auditing for multiple companies, and it becomes easier for them to audit it if it's in a similar format. And it ensures transparency as well, as no information is hidden in the statement if they follow the same format. So, this is why a standardized accounting system, or we can say standardized financial statements, are required. Now, let's understand what is Companies Act 2013. Companies Act 2013 governs the incorporation, management and reporting of a company. It has replaced Companies Act 1956, because the new and modern policies related to corporate governance has to be introduced. More transparency, more visibility and more trust in stakeholder has to be developed. That's why with new policy, new terms, Companies Act 2013 came into existence, and it replaced Companies Act 1956. So, a modern corporate governance framework was the main reason of this change. So, the act was reformed to maintain global standards, fraud control and investor protection. The objective of this act was to protect shareholders, increase transparency, strengthen audit accountability and ensure proper disclosure and reporting. Now, let's understand what is the company law of financial reporting is there. Now, this act, Companies Act 2013, has devised Schedule 3 for maintaining the statements. So, these Schedule 3 of Companies Act shows that how we should maintain our financial statements. It is governed by 4 major bodies. First, Companies Act 2013, SEBI guidelines, ICAI guidelines, and we have the global standards. So, specific structure of financial statement it has prescribed. It is mandatory to compliance with Schedule 3. It mandates that audit and internal control should be there, and Schedule 3 acts as a backbone for corporate reporting. So, if company has to run, they have to follow the Schedule 3 and these 4 major bodies governing them, and then only a company can work. Now, what is the general requirement for it? First, it is true and fair view. It has to show a true and fair view to its stakeholders. It should be on accrual basis. Accrual basis means as and when the transaction happens, it has to be recorded irrespective of when we are receiving the money out of it. Going concern assumption has to be taken that the company is going to run for an infinite period of time. There is no proper end date to the company. So, going concern means the company is going to have a perpetual succession. It is going to run for a longer period of time, and based on that all the transactions should be recorded. There should be a consistency in following the accounting policies as well. Whatever accounting policy is being followed by the company, it should run for a longer period of time, and whenever the policy has to be changed, it should be given under the notes that why it is changed and what new changes are brought in. And it should comply with accounting standards. It should comply with the standards given by Indian accounting system. Now let's come to the major part for today, that is what is Schedule 3. Schedule 3 of Companies Act 2013 gives us a prescribed format for recording the financial statements. It is mandatory for all the companies. It gives a proper format which has to be followed by all the companies, and no company can alter the format for their own will. So they have to properly follow the format for it. So what's the main reason behind it? That it standardizes the presentation of the financial statement, be it be balance sheet or profit and loss account. It has a proper statement, it has a proper format. This Schedule 3 is divided into two parts. Part 1 solely decides the format and functioning of balance sheet. Part 2 works on the statement of profit and loss account. We will learn about both of these in the session. Let's come to what is the main objective of Schedule 3. As we have discussed till now, that if we talk about Companies Act 2013, if we talk about accounting standards, or if we talk about any accounting policy, all talks about having a transparent, uniform and trustworthy financial statement reporting. So similar way, the objective of Schedule 3 as well is to have a uniformity which can facilitate comparability in different financial statements, and the data which is being provided there should be transparent, and there should be a logical grouping of all items. Means the transaction can be of n number of nature. We cannot have all the transaction recorded separately. It should be grouped in a logical manner. Structure of Schedule 3, that all the format, be it balance sheet or statement of profit and loss, it should be followed in vertical format only. What is this vertical format? Earlier, a T-shaped balance sheet or profit and loss account was maintained, where one side it used to be liabilities, the other side it should be asset. But now it is a vertical format, means now it will be one account where on top it will be liabilities, on the downside of it will be asset. Similarly, it goes with the profit and loss account, which we will learn in today's session. So, and all the items which are presented here should be classified into logical groups, current and non-current. Notes should be compulsorily given in the formats at the end of the statement. Any kind of changes made in the statement should be put under the heading of notes, and it is required for cross referencing as well. Now let's talk about the part 1, that is balance sheet. Balance sheet, as I just told you, it is divided into two major categories: equity and liabilities and asset. Equity liabilities is placed on top side of the balance sheet, where it is categorized into 4 subgroups. The first subgroup is shareholders fund, the second subgroup is share application money, third subgroup is non-current liability, and fourth subgroup is current liability. There we have the downside in the balance sheet, we have the major heading asset, in which subgroups are non-current assets and current assets. Let's understand these. The first one, share capital presentation. Share capital is presented in 3 categories: authorized capital, issued capital and subscribed capital. These are 3 different capital categories in which the amount has to be entered. Then any calls which are asked but unpaid should also come in the place. Forfeited share, any cancelled shares, that also will come into this line. And shareholding structure. Shareholding structure will show that any shareholder who has more than 5% of the shareholding will be placed in that matter. So, in share capital presentation, we have authorized, issued and subscribed capital, calls unpaid, forfeited shares and shareholding structure. This is the first subgroup. Second subgroup is reserves and surplus. Reserves and surplus shows capital reserve, securities premium, general reserve and surplus, either profit or loss balance. Capital reserves any kind of extraordinary transaction like sale of old asset where some benefit is earned by the company will come under capital reserve. Generally, this capital reserve is not used for distribution as dividend. Only general reserve money is used for distribution as dividend or any other purpose. Capital reserve is kept for emergencies related to capital nature. Then surplus, which comes from profit and loss account, either surplus or deficit will come here and that will get placed under the capital and it will be either added or deducted. Next, non-current liabilities. In non-current liabilities, these are the liabilities which are of long term, like long term borrowings, any kind of loan, bank loan, bonds will come under here. Deferred tax liabilities and long term provisions will come under non-current liability. Anything which is of long term and is a debt for the company will come under this. And the fourth category is current liabilities. Short term borrowings, for example creditors or we can say short term loans will come under it. Trade payables, other current liabilities like outstandings, we have like outstanding salary, outstanding rent will come under this, and short term provisions. With that, the second major heading is assets. Under assets, we have the first subgroup, that is non-current assets, or we can call it fixed assets. In fixed assets, we have the items like property, land, building, plant, equipment. This will come under one category. Then intangible assets like goodwill, patents, that will also come under this. Capital, work in progress and non-current investments will come under non-current assets. Apart from it, we have another subgroup in the asset category, that is current assets. Current assets are like inventory, which is our stock, trade receivable like bills receivable, cash and cash equivalents like marketable securities or bank amount, and short term loans and advances will come under current assets. Now let's come to the schedule 3 part 2, that is a statement of profit and loss. Schedule 3 part 2 talks about how we record our expenses and our receivables. So format of profit and loss is again in a vertical format, where on top we record all the revenue, all the incomes, and then we deduct the expenses out of it, and finally all the income minus expense will form as either we have a profit or a loss. So the sequence of how we record in profit and loss statement is first revenue from the operation. Whatever money we have received from the operation, we will add other income into it, then we will deduct the expenses, then we'll deduct the finance cost, deduct the depreciation, then profit before tax we will get when we deduct our revenue, when we deduct our expenses from the revenue, we get profit before tax. Then we pay the taxes and we get profit after tax, and from that profit finally we get the EPS, that is earning per share. So there we get that how a particular shareholder receives. Now let's understand these items here. Revenue recognition. Any revenue which we receive from sale of goods or income from service or any operating income will come under revenue. There are other incomes also which comes under, like sale of old newspapers or some other additional income from somewhere will also come, like rent received also will come under that. Then we have the expenses classified. Cost of material consumed, any purchases during the year, any employee benefits are there, finance costing or any other expense like rent, electricity, legal fees, all these expenses will be recorded. Once that is done, then we have the exceptional items being shown there. It will be shown separately. Why it is shown separately? So that it enhances the clarity. It is non-recurring in nature. It will not happen again and again. Once in a while it occurs. So that's why it's shown separately. Like for example, profit on sale of a machinery. An old machinery is sold and some amount came as a profit. Now every year or every day you are not going to sell a machinery. So that is, it is exceptional item which comes under this category and it will be recorded separately. Once all the revenue and expenses are calculated, expenses will be deducted out of revenue and we will get profit after tax. That profit is then divided by number of shareholders we have, and by dividing it we get our earning per share. Earning per share is important for shareholder evaluation as well as for stock market analysis. Now, there are few general instructions when we prepare our balance sheet and general instruction when we prepare the profit and loss account. So, the general instructions for balance sheet is cross-referencing required. Whatever amount or item which is getting placed in balance sheet, there should be a cross-referencing, means we should know from where the amount is coming in. So, that cross-referencing, if we want to check that this particular item has got its place in balance sheet where it's coming, that referencing should be there. Disclosure of contingent liability. Any liability which is contingent in nature means it is not yet sure but it may appear in future, that also should be disclosed below the balance sheet. Disclose aging of receivables, means how old the receivables are, that also should be mentioned below the balance sheet. Round off requirements. If there are amount which ends with points, then there should be a proper rounding off so that the balances can be equalized or the balances can be clear in understanding. And comparative figures mandatory. Whenever the balance sheets are prepared, it is prepared for a year, but previous year balances also should be mentioned alongside so that a comparative analysis can be done. So, the balances of previous period should be also mentioned along with this year's balances. These are the general instructions related to balance sheet. Now, general instructions for statement of profit and loss. The first instruction is revenue classification. The revenue classification should be there, that under what category any amount has entered the business. So, the transactions related to recording of revenue should clearly tell that from what source that particular money is coming. It should be properly classified. Prior period item should be given. Depreciation as per schedule 2. There should be a depreciation according to schedule 2, how it is recorded. Depreciation is given on the fixed assets like land and building, equipments, machinery. On these items depreciation is calculated. So, this depreciation amount should also be clearly stated, that for which particular machine, land or vehicle that amount is deducted. So, what percentage and what method is being followed to calculate the depreciation, all that should be given under the notes of profit and loss account, so that it is not creating any confusion for the people who want to understand it. Disclosure of dividend. At what rate the dividends are being distributed, that disclosure should be there. So, this comes for the purpose of earning per share calculation. So, how the dividends are being distributed, that should be disclosed in the profit and loss account. Detailed notes for all expenses head. There should be a detailed notes for all the expenses which comes, whether the expenses are for this year or it is for previous year. It should be clearly put under the expenses head. If these instructions are not followed, penalties will be provided. Then there for non-disclosure of anything, there will be penalties for the company. Then comes the notes to the account, where the company has to give accounting policies, contingent liabilities, commitments, related party transaction and segment reporting should be given. Now let's summarize what we have learned today. In today's session, we have learned about what joint stock company is, what is the structure of financial accounts, Companies Act and Schedule 3 we have learned. Then we learned that Schedule 3 Part 1, that is related to balance sheet, Schedule 3 Part 2 related to profit and loss statement, and instructions for preparation of balance sheet and profit and loss account. That is for today. Thank you.